For years, my portfolio was a fortress built on the bedrock of Silicon Valley. I held significant, high-conviction positions in the titans of technology, riding the wave of digitization that defined the last decade. But recently, I executed one of the most aggressive and controversial pivots of my entire career. I have liquidated nearly every single technology position I own. I have taken that capital, millions of dollars of exposure, and rotated it entirely into a sector that most modern investors.
This was not a decision made lightly. It is a calculated, strategic repositioning based on a fundamental disconnect.
Over the next few minutes, I am going to dismantle the consensus view on the stock market. I will break down exactly why I exited the market's darlings, reveal the specific assets I have acquired to replace them. This is the Capivestor blueprint for the Great Rotation. To understand where we are going, we must first understand what I left behind. For half a decade, my wealth was tied to the giants: Meta, Alphabet, Amazon. These are not just companies. They are economic empires with wide moats and the ability to print free cash flow. Historically, they have been the engines of modern wealth creation. If you had allocated capital to these heavyweights 5 years ago, you likely witnessed your portfolio double or triple.
But in the world of professional capital allocation, past performance is not a proxy for future returns. In fact, it is often the inverse.
I sold these winners for a single, terrifying reason: valuation gravity. The concept is simple, but the context is critical. Markets operate on cycles of fear and greed.
When an asset becomes universally adored, when it is held by every pension fund and retail trader, and
right now, the market is in a state of euphoria regarding big tech. The consensus is absolute, and that terrifying.
We are seeing Meta trading at 25 times forward earnings. Microsoft is hovering around 30 times. Amazon is pushing 35 times.
to justify a 50 PE ratio, a company cannot just be good, it must be perfect, forever.
The consequence of paying these prices is severe. When you buy a stock at 50 times earnings, you have removed the safety net of valuation expansion. Your returns are now mathematically tethered entirely to earnings growth. If a company priced for perfection delivers anything less, if growth slows from 30% to 20%, the stock does not just stay flat, it crashes. This is the phenomenon of multiple compression. If a stock's multiple contracts from 50 down to 30, that is a 40% decline in the share price, even if the underlying business is still growing. I have seen this movie before. I have watched high-flying growth stocks transition into mature value stocks, and the repricing event is often brutal. I would rather leave the last 10% of profit on the table for the next guy. But valuations are only half the story. The other reason for my exit is a systemic threat known as concentration risk. The S&P 500 has effectively become the S&P 7. The 7 largest companies, Apple, Microsoft, now comprise roughly 30% of the entire index. Think about the fragility of that structure. If you own an S&P, you are not. You are heavily leveraged into a single trade: big tech. This concentration, or a supply chain disruption for Apple, creates a shockwave that drags down the entire market. And make no mistake, the regulatory wolves are circling. Antitrust investigations, data privacy laws, and breakup threats are looming over these giants. The market is currently pricing these risks at zero.
I believe that is a fatal miscalculation. Furthermore, the macroeconomic landscape has shifted beneath our feet.
These tech giants flourished in a zero-interest rate phenomenon, a decade of free money where capital cost nothing. That era is dead. We are now in a higher-for-longer environment. When the cost of capital rises,
This is a hostile environment for expensive growth stocks. So, having liquidated these positions and secured my profits,
I have redeployed this capital into the one sector that the modern world loves to hate.
This is the sector that ESG mandates have blacklisted. It is the sector that university endowments are divesting from. It is the sector that is currently trading at the deepest valuation discount I have seen in my professional lifetime.
This is the sector that ESG mandates have blacklisted. It is the sector that university endowments are divesting from.
The consequence of paying these prices is severe. When you buy a stock at 50 times earnings, you have removed the safety net of valuation expansion. Your returns are now mathematically tethered entirely to earnings growth. If a company priced for perfection delivers anything less, if growth slows from 30% to 20%, the stock does not just stay flat, it crashes. Let's talk about the value arbitrage. While the S&P 500 trades at 20 times earnings,
And tech trades at 30 times.
Top-tier energy companies are trading at 6 to 8 times earnings.
this is a 70% discount to the broader market. You are effectively buying dollar bills for 30 cents. This disparity exists because of a pervasive narrative: the death of fossil fuels.
The world is convinced that tomorrow we will all drive electric vehicles. The wind will power our factories, and oil demand will collapse to zero. However, as we will explore in a moment, this narrative is not just slightly wrong. It is diametrically opposed to the physical reality of the global economy.
Here is the data that the market is ignoring. Global oil demand is not shrinking, it is expanding. We are currently consuming approximately 102 million barrels of oil every single day. By 2030, the International Energy Agency projects that number to rise to 106 million barrels. The growth is not coming from the West, it is coming from the emerging world.
Billions of people in India, China, Southeast Asia, and Africa are moving into the middle class.
They want air conditioning, they want travel, they want goods made of plastic, and they want reliable electricity.
The energy density required to uplift these economies comes, overwhelmingly, from hydrocarbons.
But what about the electric vehicle revolution? Let's apply some granularity to the hype. EVs currently represent roughly 3% of the global automotive fleet. That means 97% of all cars on Earth are burning gasoline today. Even if EV sales skyrocket to 20% of all new cars sold by 2030, the sheer size of the legacy fleet. Furthermore, transportation is only one slice of the barrel. Oil is the feedstock for the modern world. It is in the
You cannot decarbonize a petrochemical supply chain overnight. The most bullish argument for energy, however, is not on the demand side. It is on the supply side.
We are facing a structural supply deficit of massive proportions.
For the last 10 years, under immense pressure from ESG investors and governments, energy companies have been starved of capital.
They stopped drilling. They stopped exploring.
Instead of reinvesting profits into new wells, they returned cash to shareholders to appease them. The International Energy Agency estimates the world needs to invest $600 billion annually just to maintain current production.
Currently, the industry is investing only about $400 billion. That is a $200 billion annual shortfall. Over 5 years, that is a $1 trillion gap in critical infrastructure. The consequence: we are running out of spare capacity. When demand grinds higher and supply remains capped by a decade of underinvestment, the laws of economics dictate only one outcome. I believe we are entering a window where oil prices could stabilize between $90 and $120 per barrel. At those levels, the companies I am about to list do not just make money, they become cash flow machines. My portfolio strategy is specific. I am avoiding the massive integrated majors like Exxon or Chevron. Instead, I am targeting pure-play exploration and production companies, the drillers whose profits are directly levered to the price of oil.
Asset 1. ConocoPhillips.
This is the heavyweight champion of independent producers. ConocoPhillips pumps 1.8 million barrels of oil equivalent every day. Their assets in the Permian Basin and Alaska are world-class, with break-even costs so low they can remain profitable. At $80 oil, they are printing money. At $100 oil, their free cash flow yield could surge past 15%. They are currently trading at roughly 7 times earnings, a valuation that implies the company is going out of business, despite having a Asset 2. EOG Resources. Known in the industry as the Apple of Oil, EOG is a technological leader. They pioneered horizontal drilling techniques that unlocked the U.S. shale revolution. Their discipline is legendary. They only drill wells that promise premium returns.
EOG trades at 8 times earnings and boasts a return on capital employed of over 20%.
Between their dividend and share buybacks, they are returning nearly 10% of their market cap to investors annually, regardless of what the stock price does.
Asset 3. Devon Energy. Devon offers a unique mechanism for income investors. They pioneered the fixed plus variable dividend model.
They pay a base dividend, but every quarter they take a percentage of their excess free cash flow and pay it out as a variable bonus. At current prices, the yield is around 8%. In a bull market scenario, that could easily climb to 12% or 15%.
Asset 4. Pioneer Natural Resources.
This is the prime example of the value disconnect. ExxonMobil recently moved to acquire Pioneer for $60 billion.
The smartest minds at Exxon looked at the landscape and decided that buying Pioneer's Permian acreage was the best use of.
Asset 5. Occidental Petroleum. This is the wild card with the strongest backing.
Occidental is heavily leveraged to oil prices, meaning their stock moves aggressively when crude rises.
The key signal here is the legendary chairman. The holding company has been aggressively buying energy stocks, now owning over a quarter of the firm. When the greatest value investor in history is pouring billions into an oil company at these levels, it pays to pay attention.
I have also allocated capital to smaller, high-beta producers like Diamondback Energy and Marathon Oil.
These companies are trading at even lower multiples, sometimes 6 times earnings, and offer even greater upside leverage.
Now, I hear the objections. I know the counter-arguments, because they are the consensus view. Let's dismantle them. Objection 1. The ethical dilemma.
Investing in oil destroys the planet. I approach markets as a realist, not an idealist.
The transition to renewables is happening, but the timeline is measured in decades, not years. As an investor, my job's to allocate capital based on how the world is, not how I wish it to be. I choose to profit from that reality rather than ignore it. Objection 2. Peak demand. Oil is a dying industry. The data contradicts this. While the West is becoming more efficient, the industrialization of the global South is a tidal wave of demand that far. Objection 3. Stranded assets.
these reserves will become worthless. This argument ignores the cost curve.
The last barrel of oil pumped will come from the Permian or the Middle East because it is the cheapest to extract.
Objection 4. Volatility.
Oil is too risky. Volatility is the price you pay for performance. Yes, energy stocks can draw down 30%. But because their starting valuations are so low, the downside is mathematically buffered, while the upside is uncapped.
Objection 5. Technology.
Battery tech will kill oil. Again, look at the infrastructure lock-in. There are trillions of dollars of internal combustion infrastructure globally.
The turnover rate of the global car fleet is slow. We will be burning gasoline in significant quantities in 2024.
In conclusion, the market has presented us with a rare dislocation.
Conversely, we have a tech sector priced for perfection in an imperfect world. My forecast for the next 12 to 24 months is straightforward. I anticipate oil prices grinding higher toward triple digits. As they do, the massive cash flows generated by these energy companies will become impossible to ignore. Wall Street, this flow of funds will drive a multiple expansion, a repricing of energy stocks from 7 times earnings to perhaps 10 or 12 times earnings.
If you combine that multiple expansion with rising earnings, you are looking at the potential for these stocks to double or triple in value.
This is the Capivestor thesis.
I have sold the hype to buy the value. I have traded the crowded trade for the lonely one. This is not a guarantee of wealth. The markets offer no promises, only probabilities.
I urge you to look beyond the headlines, do your own deep due diligence, and verify the numbers I have presented.
If you come to the same conclusion I have, you might find that the dirty energy sector is the cleanest path to outsized returns in the coming years.
The game of capital is shifting. The question is, will you shift with it?
I'm Capivestor. Master the game of capital.